Hello learner, welcome to Manifested e-learning forum. My name is Emily Ngwiri. I'll be taking you through equity investment analysis, and we are looking at private company valuation. Under private company valuation, we will continue from what we had looked at in our previous lesson, and we will build on the valuation approaches. So the topic is private company valuation. And now what we'll build on, we will build on the three valuation approaches we had looked at in our previous lesson, including the income approach. We had looked at the income approach, we had looked at the market-based approach, and we had looked at the income, we had looked at the market, and we had looked at the asset-based approach. So these three approaches are the ones we're trying to break down, demystify in detail, and we will be able to specifically start off by looking at the income approach right there. What methods are used to value private companies under the income approach? So now we will start first of all by looking at this central point. So our central focus will be, if you'll allow me, I can start over here. So the income approach to valuation there. And what specifically we look at under the income approach, we look at the free cash flow method of how to value private companies. Then we look at the capitalized cash flow method, that. And then we will conclude by looking under the income approach, we will be looking at the excess earnings method, there. Under the capitalized cash flow method, we will be able to look at an example so that we can be able to reinforce our understanding. As well, we will also look under the excess earnings method, we look at an example thereon so that we can be able to also reinforce our understanding. The free cash flow method is just simply the two-stage free cash flow method. I'll be able to break it down in a little while. Then, having looked at that, we will build on and we'll continue to look at the factors that require what we're looking at over here is, remember, we're looking at the private company valuation. So we'll look at the factors that require adjustments when estimating, discount rates under private companies, when estimating discount rates under private company valuation. There, the factors that require adjustments when estimating required rates of return there. So that will be able to now conclude this lesson. And we first of all begin by looking at the income approach, where under the income approach, in our previous lesson, what we had said the income approach requires us to estimate the present value of the expected future residual income. Yes, so we're saying here, or we can say under this method, the present value of expected future income is determined and is used to get the value of private company. That. So we start off by looking at the first method, the free cash flow method. So we have number one, free cash flow method. Now, under the free cash flow method, this requires the analyst to estimate the two-stage free cash flow to farm there. So we are saying, we can say here, is analogous to the two-stage free cash flow free cash flow to farm there. And if you recall, under the free cash flow topic review, we had said the two-stage, or rather, when trying to estimate the free cash flow to farm, FCFF, we had said is given as net income plus non-cash charges, which is depreciation and amortization, plus interest, after-tax interest expense, 1 minus tax, minus fixed capital investments, minus working capital investments, like that. So now what we need to do over here, we need to first of all arrange this free cash flow to farm formula in a columnar format, so that we can be able to now subject these to changes, of these inputs to changes, say in the growth rates of residual of net income, of non-cash charges, interest, and the like there. So we will be able to probably put it like net income, non-cash charges, interest, 1 minus tax, fixed capital investments, working capital investments, like that. So that now we know that once we get year 1, 2, 3, 4, and 5, like that, the growth rate here will be, in say for example, the growth rate in net income, non-cash charges, fixed capital investments, and working capital investments will grow at a stable stage of about, of a stable rate of about 5%. And then it will decline now from year 6 thereon. These components which I have put asterisks there will decline to another rate at a, say for example 2.5%, like that. So we effect those changes like that, and then we can be able to get the corresponding FCFFs there. So the free cash flow to farms they are gotten for year 1 is gotten X, Y, Z, V, U, and M, like that. They're all gotten like that, and then we use the discount factor component of weighted average cost of capital. Remember, the FCFF, or the free cash flow to farm, is discounted using weighted average cost of capital. So we're saying the value of the farm is given as, we say FCFF 1 over 1 plus WACC, 1 plus, now since you're going 5 stages like that, you can continue like that, FCFF 2 over 1 plus WACC, like that, power 2, and so on and so forth, like that, until we reach FCFF 5 over 1 plus WACC, like that, power 5. However, from year 6, we need to compute the terminal value. The terminal value is important because we need now to discount now from the component of the terminal value. Like now we are saying at the end of year 6 right there, we now discount it from here thereon. We need to discount it back to year 6, and then back again discount it back to year 0, so that we can be able to see the estimate of free cash flow to farm right there. So we are saying that once we have the terminal value, so we are saying the terminal value is the one for year 6, which is the year 6 FCFF, which we are saying is N. So we're saying N over WACC minus G. We get Q there. Q is what we'll discount now right over here, plus F plus Q. Saying over here, apologies for that. We're saying Q over 1 plus WACC power 5, just similar to the way we've written over here. So this is the component of perpetuity. Perpetuity component is what we're discounting right there. So please look at that topic review, the way we had done the two-stage FCFF, so that you can be able to recall how we had actually done it. That is the similar way of how we can be able to compute the free cash flow method under the income approach of private company valuation. Now, moving on, we look at the capitalized cash flow method. Capitalized cash flow method number 2. cash flow method. There. Now, under the capitalized cash flow method, it is the computation of the FCFF based on single stage, not two-stage. This is the one that we use, the two-stage. The free cash flow method uses the two-stage model. The capitalized cash flow method is analogous to the single stage. So we can say is analogous to the single stage free cash flow to firm. If the free cash flow to equity is required, the value of equity rather, the value of equity is required, value of equity is required, comma, we can say then we can get the value similar to the way we had gotten it under the free cash flow to equity, FCFE, free cash flow to equity method. What am I saying? I'm saying the value of the firm is given as FCFF, the forecasted FCFF, or the free cash flow to firm, over WACC minus G. Notice one thing. Here we are getting the free cash flow to firm, yes. That component of free cash flow to firm, we were subjecting the key inputs over here, net income, non-cash charges, fixed capital investments, and working capital investments, to an increase based on the growth rate. So they're growing maybe say at 5%. So you affect those changes. Year one, you have the net income growing at 5%. Then year two, 5% increase from the previous value. Here, 5% increase of the previous value, like that, until we reach over here. When you move to year six, it is 2.5% increase of the previous value right over there, meaning that that is for two stages of growth. We have the first stage of growth up to year 5, the second stage of growth from year 6 and moving on. Now here we are saying we will be able to use single stage model. The single stage model, the value of the firm is the FCFF over WACC minus G, like that. If you get the value of equity, or you've been asked for the value of equity, we are saying it will be the FCFE over R minus G. We had said what under free cash flow method. Under the free cash flow method of computing the value of the firm, we had said FCFF is discounted based on WACC, weighted average cost of capital. And under the value of equity, we discount it based on required return there. So for us to try and reinforce our understanding, let's look at an example on how we can be able to compute the capitalized cash flow method. The example is as follows. Given the following figures, calculate the value of the firm and equity using the CCM. The CCM is the capitalized cash flow method. So we have the FCFF in year 1, 12,100,000. We have the growth rate in FCFF as 4%. The WACC is given to us as 15%. The market value of debt is given to us as 4 million. So based on that information, we need to first of all get or understand if we've been given the free cash flow to firm, the forecasted free cash flow to firm, or we've been given the historical free cash flow to firm. If we have the historical free cash flow to firm, the value of the firm would be FCFF 1 plus G. We grow it so that it can be the forecasted, we can get the forecasted value over WACC minus G, like that. But now in this case, we have been informed that FCFF in 1 year, so we've already forecasted the FCFF component. In this case, it is not FCFF the way it is like that. It is the FCFF like so. So the FCFF subscript 1 there. So it's the forecasted FCFF. So once we have that, we can come on this side. so that we can be able to slot in the inputs in the formula and get the FCFF, or the value of the farm rather. So the FCFF in 1 year is 12,100,000. Like that. We discount it against the weighted average cost of capital. We've been given 15%. We can put it in decimals, 0.15 minus the growth rate. The growth rate in FCFF is 4%, 0.04. So how much do we get as the value of the farm? Value of the farm. So this is VF like that. So very quickly we have 12,100,000 divided by 0.15 minus 0.04. We have 110 million. 110 million like that. Now, once we have the value of the farm, what we need to do is that, because we've been requested to get the value of equity, if we have the value of the farm like so, VF, and we exclude the component of debt like so, this is the debt, what we remain with over here is the value of equity like that. So we can apply this concept when trying to get the value of equity, because we've already been given the market value of debt. So we are saying the value of equity is given as the value of the farm minus debt. Yeah. So which we're saying the value of the farm is, we've already calculated 110 million. Then we less the component of debt, which we've been given as 4 million. Like that. So that means we have 110 minus 106, 106 minus 4 million, looks like 106 million. 106 like that. So that is the value of equity there. If you've been asked for the per share value of equity, then that would mean we'd have to divide this by the number of shares outstanding. In this case, we haven't been given the number of shares outstanding. What we need to understand is that this component right here represents what? Represents the capitalization rate. What in the investment community people like to refer to as cap rate. Cap rate there. The cap rate is the discount rate minus the growth rate there. Now let's look at the third method under the income approach, which we are saying is the excess earnings method there. The excess earnings method, what we call the EEM method in the investment industry. So we can come here. Number 3, excess earnings method. Yeah. So under the excess earnings method, we can say this. We can say earnings, this refers to the earnings that should be generated. It refers to the earnings that should be generated by working capital and we can say and fixed assets based on estimates, of required return, That we're saying it refers to the earnings that should be generated by working capital and fixed assets based on estimates of the component of required return. We continue and say this, that excess earnings are farm earnings. Excess earnings are farm earnings minus earnings required earnings required rate of return, on working capital and fixed assets. Required rate of return on working capital and fixed assets. That. So under the excess earnings method, we are saying we will be required to compute the required return on working capital and fixed assets so that we can be able to normalize the earnings there, or we can be able to also determine the excess earnings. Now the excess earnings will now be discounted so that we can be able to get the value of the private company. Let's look at an example that is going to try and help us understand how the excess earnings method works. Given the following figures, calculate the value of the firm using the EEM or the excess earnings method. Working capital, been given 300,000, fixed assets 1 million, normalized earnings year just ended 130,000, required return on working capital, required return on fixed assets, you've been given as 10%, and the previous value you've been given as 6%. The growth rate of residual income is 5%. Discount rate for intangible assets is 14%. So now, using the EEM method, we will just follow this so that we can be able to try and understand. So the first thing is that we need to compute the required return on fixed assets and working capital. So we say, and we've been given the required return on working capital and fixed assets. So required return on working capital and fixed assets. So what rates have we been given there? You can see the working capital is 300,000, the fixed assets is 1 million. The required return on working capital is 6%. The required return on fixed assets is 10%. So we just say fixed assets. We have fixed assets of 1 million there, multiplied by the required return on fixed assets, which you're seeing is 10%. That looks like 100,000 there. Then we can compute on working capital. Working capital. We have working capital as 300,000. Then we multiply by the required return on working capital, which you're saying is 6%. Yeah. So how much do we get there? So you can see 0.06 multiplied by 300,000. Looks like 18,000. Yes, we have 18,000 there. Once we have computed that is the required, those are the required returns of working capital and fixed assets. We now need to calculate the excess earnings. The excess earnings, we said, the excess earnings are firm earnings minus earnings required rate of return on working capital and fixed assets. So we need to say the firm earnings minus 100,000 minus 18,000 so that we can be able to get the excess earnings. Remember, it is the excess earnings method that you're looking at. So we are saying we need to now identify the value of the normalized earnings. So normalized earnings like that, we've been given as 130,000. So once we get 130,000, we less 100,000, we less 18,000 there. So we say excess earnings is given as 130,000 minus 100,000 minus 18,000. How much do we get as the excess earnings? So 130 minus 100 minus 18, and we get 12,000 there. that. That's the excess earnings. From there, what happens? We now need to discount and discount the excess earnings so that we can be able to discount this value and get the value of intangibles. We will apply a discount rate based on the intangible assets as provided in the question right there. So let's do that. So what happens is that now value of intangibles. Okay, the value of intangibles, we discount the 12,000. So we apply the first of all, we need to identify the formula. The formula will be to get the value of the firm, or rather value of intangibles. I there is the excess earnings 1 plus G over, now we apply the component of intangible assets. So intangible rate minus growth rate minus G, which you're applying right over there like that. So putting it all together, the excess earnings, we already have 12,000. 1 plus, what is the growth rate there given to us? The growth rate is 5%. You can see the growth rate in residual income is 5%, so 0.05. Then we did the intangible rate. The intangible rate given to us there is 14%, 0.14 minus the growth rate, which you're saying is 0.05 right there. So what happens? What we get there? So we're saying is 12,000 times 1.05 multiplied by 1.05 divided by 0.14 minus 0.05 there. So we have 140,000. 140,000. That is the value of intangibles. Now we get the value of the firm. Remember, we're trying to determine the value of the private company firm. Saying the value of the firm will now be, we add the working capital component. So value of the firm, pardon me. Firm. The value of the firm will be, now we add 140,000, which is the value of intangibles, plus the component of fixed assets 1 million, plus the component of working capital there. So we add plus 1 million plus 300,000 there. So this looks like 1.3. This one looks like 1 million. This is 1.3. 1 million, 1.3. This looks like 1.4. 1.44. 1,440,000 like that. That is the value of the firm, private company firm there. Now, having looked at those three methods under the income approach, we will conclude this lesson by looking at the factors that require adjustments when estimating the discount rates there. So that is the final component there. So factors that require adjustments when estimating discount rates under private company valuation. So we say factors that require adjustments when estimating the discount rates. Rates for private company valuation. What factors impact or affect or will require adjustments when trying to estimate the value of the private company? The first component that we need to look at is the size premium. Size premium. Now, what we need to do is that we say size premiums are added or need to be added so that we can be able to, they need to be added to the discount rate, so that we can be able to estimate the value of the private company there. So we say the size premium needs to be added to discount rates, to the discount rates in when estimating the value of private firms there. We're saying that private firms tend to be much smaller as compared to public firms. Public firms are considered to be larger in nature in terms of the assets, in terms of the liabilities, in terms of the company structure, the employees, and everything. So we're saying size premiums need to be added to discount rates when estimating the value of private firms, because private firms are considered to be much smaller. The second point that we need to look at there is availability and cost of debt. Availability and cost of debt. Availability and cost of debt. We know very well that private companies tend not to have easy access to both equity and to debt components, and hence due to that lack of accessibility to debt and equity, we are saying that some component of a premium needs to be added to the weighted average cost of capital when estimating the value of private companies. I can say that again. The availability and cost of debt for private firms, both in equity and debt, comes at a challenge as compared to public firms, because of the public firms have got generally have a greater goodwill as compared to private firms. And so we are saying when estimating the weighted average cost of capital, the WACC, a small premium needs to be added onto the WACC, so that you can be able to cover up that component of lack of accessibility of both debt and equity cost of capital. So we can say something. We can say that WACC is higher for private firms. WACC tends to be higher for private firms as compared to public firms. Due to the difficulty in accessing equity and debt sources of finance. Difficulty in accessing equity and debt sources of finance. That is in the case of private firms there. Now we look at the third point, or third factor that affects discount rates, or need to be applied to discount rates. We look at projection risk. That's the third factor there. Under projection risk, you're saying due to the inexperience of the analysts or the workforce within private firms, you tend to find that they may not have that capability of knowing how to project financial or cash flows there, so that they can be able to estimate future cash flows there. So you say that this is the risk that experts, or we can say analysts within private firms lack the experience in forecasting future cash flows with accuracy. So they tend not to be able to forecast the future cash flows with accuracy because of that lack of inexperience. So that is the third factor. The fourth factor is the life cycle stage. The life cycle stage. Now, under the life cycle stage, we know that private firms tend to either be at this initial part over here, as compared to public firms, which tend to generally, at a greater scale, be at the mature. This is the growth or embryonic stage. I can say the embryonic stage of the life cycle there. So you tend to find that one of the factors that require adjustments is the stage in the life cycle. You cannot be able to estimate the value of a private company similar to the way you can be able to value public company, because the public company tends to be at a mature stage. In terms of the cash flows tend to be at least much more predictable as compared to private companies. So we can say under the life cycle stage that adjustments need to be considered. Adjustments need to be considered when estimating future cash flows. Because private firms tend to be under the embryonic stage, unlike the public firms that majorly are at their maturity stages there. So those are the factors that require adjustments when estimating the discount rates for private firms. The life cycle, the discount rates based on the life cycle needs to be considered, because the discount rates should be higher for private firms as compared to public firms, because the life cycle tends to just be growing over there, and the availability to access debt and equity capital may be a bit challenging as well. Their cash flows may not also be very predictable, and hence the discount rates will also have to be slightly inflated as opposed to public firms there. This brings us to the end of this lesson. We hope that you can be able to join us in our next lesson, where we will still be continuing with private company valuation. Thank you, and God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.